everyone. Thank you for joining today's webinar, The 5 Reasons Why Most Traders Fail and How to Avoid Them. Today's speaker is Andreas Clenow, Chief Investment Officer at Aesius Asset Management, a Zurich-based investment group with a 9-figure asset base. Andreas started out as an IT entrepreneur in the 90s and eventually became the global head of commodity and equity quant modeling for Reuters before leaving for the hedge fund world. Having founded, managed, and seeded multiple hedge funds, Andreas now oversees investment management across all asset classes, covering quant trading, private equity, and venture capital. He is also the author of the critically acclaimed book, Following the Trend, and you can learn more at followingthetrend.com. Thank you for joining us, Andreas.
Thank you for the introduction, Paige, and thank you for inviting me here. Yes, as you heard, my name is Andreas Clenow. I dare to claim at this point, the most prolific QuantCon speaker, I believe, having shown up at, 5 events, I think, their conferences in New York and Singapore the past few years. And those, in case you haven't attended them, in the past, you probably should do so in the future. They're some of the best conferences out there. Now, today, I've been asked to do a presentation regarding mistakes that traders make. And I tried to boil it down to just a few of them. And I'm going to do it in a numbered list form because I hear that's all the rave on the internet these days. And I want to show that the old man can play the kids' games here. There are many different types of errors that people make. And some of them might seem very obvious to most of you. Some may be completely new, and hopefully I find something that helps all, or at least most of you guys who are listening to this today. Let me apologize in advance for speaking slightly fast. I am very prone to doing so, and in particular when I don't have a live audience in front of me, so I can see when they start looking confused. Now, first point, or rather point number 5, is there we go. Point number 5, blind belief in nonsensical methods. Now, you may have noticed that the word technical analysis appears in the top right part of this slide. And that means I probably already pissed off a few of you. And in case you're not upset yet, don't worry, I'm going to get to your favorite things throughout this presentation and probably hit something that makes you upset. Technical analysis is essentially quite an old discipline. It's been around at least since the 70s. It is based on analyzing the markets using price series of historical prices, historical volume, and sometimes open interest when you deal in derivatives. If this sounds familiar to you working with quant finance, it's because it should be. Technical analysis is, after all, the grandfather of what we now call quant finance. And those of us working in the quant finance field owe a great debt of gratitude to the technical analysis guys for coming up with this in the first place, for making it generally accepted and showing that these type of methodologies can work. So I'm not completely panning the whole area here, but the problem with technical analysis is scope drift. Basically, anything can be accepted as technical analysis. Anyone can come up with any type of method or idea that has to do with prices, claim that this is a new technical analysis method, and there is very little peer review, critical thinking, and the field has long ago grown into something very far from what it once was. Nowadays, technical analysis can be anything from moving averages to trend lines to magical numbers and outright astrology. And most people starting out trading, the first thing they come into contact with is some sort of technical analysis methods. Much of this is seen as some sort of universal truth because, well, it's presented as such mostly in books. I used to read a lot of technical analysis books back in the mid-90s when I started out. For those a little bit younger than me, books is what we used to read before the whole blog thing took off. One such common method. I'm going to single out a few of them, a couple of them as particularly troublesome, and one is of course magical numbers. It puzzles me after all these years that especially beginner traders are obsessed with numerology, magical numbers. The most common problem is so-called Fibonacci series. Fibonacci series, for those of you who are lucky enough not to have been in contact with them, is a number series that Leonardo da Pisa came up with a few hundred years ago, which, well, I believe he originally used it to predict the growth rate in a flock of rabbits. It's a flock or a herd, a group of them. Now, if you divide each consecutive number in this series, you arrive at various magical ratios. And according to these ideas, you are able to predict exact market turning points, highs and lows, and so on by using these ratios and these numbers. 61.8, I believe, for instance, as some sort of target percentage move, which supposedly is more accurate than approximately 2/3, which statistically is more or less, well, has more or less the same predictive power. The problem with these kind of things is that they are pretty much impossible to properly quantify and verify, and therefore people can go on claiming that this is some sort of valid methodologies to use. A closely related concept is, of course, magical waves. Most commonly known as the Elliott waves. Elliott waves is basically a religion that's based on the idea that everything in the universe works in waves. You have 5 waves up and 3 waves down. And if you can just figure out exactly where we are in this magical wave pattern, you can predict the future. This is a little bit like clockwork universe, the clockwork universe theory, if anyone here has studied older physics ideas, that somehow the world is predictable in this way, and obviously this is not how the world works. This is not how the market works. If you ask somebody who works with this whether or not you should use pure price series, total return series, or how should you adjust for splits, dividends, what if it's futures, derivatives, how do you adjust for term structure? There are no answer to this, because people who use this kind of methods never really thought that far and probably didn't really know that much about the market to understand the problem in the first place. Now, this is clearly something to be avoided, and if something sounds like superstition, it probably is. And if you hear the counter argument, for instance, that your favorite investment bank, Morgan Stanley, JP Morgan, Goldman Sachs even had some analysts writing about these things, well, of course they do. For the same reason as you see these methods built into various charting packages, various financial software. As you heard before, I used to work on that side, on the software side, on the Reuters, and it's there because somebody pays for it. Of course, Goldman Sachs is not dumb enough to actually trade on this, but they're happy to write analyst report for somebody else to risk their money on it. Just like software, when vendors have nothing to lose by putting this stuff in their software. Okay, this is the more outlandish things, but a more common problem, we assume that you're not into the outlandish stuff, is, well, indicators and chart patterns. Now here's more troublesome, because much of this can actually be useful, potentially useful anyway. But the problem is, when you read about all these indicators and these chart patterns, you get preconceived ideas about what works and what doesn't, without necessarily understanding why or how. Take something like the RSI, for instance. It's a commonly used overbought, oversold type of indicator. And it has its place. It has some sort of value in some situations. But if you get 100 technical analysts in a room together and you ask them to define RSI and show you the formula, very few of them will be able to show you the formula. And if multiple of those who can show you a formula show slightly different formula. And And still everybody agrees that you should buy when something crosses something, which doesn't make any sense. The problem is that this limits your thinking. Even if this type of indicator can be useful, my advice is build your own. Build it from scratch. Why would you trust somebody else's math, especially if you don't understand it? If you want something like this to show you this particular type of information, then you build it yourself. You know how it works. You know what it does and what it doesn't, and it's applied to your specific methods. And now you know what you're doing instead of just following that some book said that when it crosses 30, you buy, or whatever it is. And it all boils down to this. Don't take anyone's word for it. You have to model it, test it, and see what comes out. And this is a recurring theme in the presentation today, that critical thinking and verifying things. Because there's a lot of things out there that people take for granted, which are not necessarily true. And that is part of the reason why most traders, especially hobby traders, end up losing their money. So that's point number 5. Point number 4 is slightly related. Point number 4 has to do with the obsession among hobby traders, and don't worry if I sound condescending, I used to be one, with quotes, mantras, and, well, hero worship, lack of a better word. There are many things where you're supposed to believe certain ideas that sound good. Usually they can be summarized in a few words or a few quotes, often rhyming. There's some attitudes and things that people think you're supposed to say and supposed to think. A classic is the one you see again here at the top part of the slide. Now, if you ask a complete junior trader in a job interview why he wants to trade, you almost always get a variant of this. He wants to trade because of the love of the game, the challenge of the 4-dimensional puzzle, the intellectual game against every other trader out there, one of the most difficult mental puzzles in the world. And yeah, well, you don't really believe that, do you? Well, if you really want a mental challenge, well, go play chess for a living, or do something useful. Go be a cancer researcher. Do something that actually has some impact. We're in this business for one reason, and that's because of the potential monetary gain that this business can offer. And if you're not honest with yourself about that, then you're probably missing something here. But these kind of platitudes are common, and you see quite a lot of them comes from various quotes or old books. And here's a quote from me quote from my favorite author, that you're free to use on your websites. I hope it shows up somewhere. I've been trying for a while to get this to at least show up somewhere without being asked. My point here is quotes in general are useless because they're almost always out of context. They sound good because a sound bite always sounds good, so something short boiled down to a short little punchy sentence. But who actually said it? What do you know about the person who said it? What are you assuming about that person? What do you know about the context that he said it in? What do you know about his motivations for saying so? It could be that this person doesn't make a living trading or has not had great success. It's possible. But let's assume that this is actually someone really smart who said it. Someone you know had a great deal of success. Or why did he say that? And in what context? Probably you can find a lot of, well, not probably, you can really find a lot of conflicting quotes from the same persons. And it's really easy to find very conflicting quotes from different successful people that really contradict each other. But even if it's very clear, why did he say it? Now, if somebody who runs, say, a long-only commodity fund tells you that you should always have a large allocation of commodity in your portfolio, yeah, of course, he's got quite an incentive to saying so, right? It's nothing to do with in this case, I would say it's nothing really to do with even ethics. He's a sales guy. Everybody sells something at some point. What's he going to say? That in the next 5 years he should have done commodities. He's got a business doing that. Put it into context, and most of the time, these little short quotes, whatever they are, however famous, it could be Livermore or whoever back in history, it doesn't make any sense. It doesn't help you. Don't pay attention to any of these quotes. Then we have the mantras, of course. There are lots of these ones. Many mantras are made to be cute little rhyming things like this, although I'm not entirely sure the last word here properly rhymes. I'll leave that to the native English speakers, which, as you all hear, I am not. The problem here as well is that when you say something, you boil something down to an easy catchphrase like this, it sounds like it must be the truth, right? Now, back in my days, we only had a quote like this. Now, these days, it seems like people are taking these things and pasting them on some little image of, smiley picture of the author, so it really looks like this is the main wisdom he had to offer in his life. And that makes it really seem true. Makes some nice little things to annoy people with on social networks, but it doesn't help you in your trading, and it's not anything you should take into account. All in all, platitudes are not helpful in most things. They might seem to be motivational, perhaps. I'm not sure, but they certainly don't help you developing your methods, or they don't help you to figure out which direction to do it or what kind of strategies you should be trading. And of course, the bottom line here is that it just isn't that simple. Different people have different points of view. People with very conflicting points of view, even in a field like trading, can have great success while having strong disagreements about how to do things. Sometimes I meet friends in the business that done very well. We have totally different views on how to do things. We can have a nice civil conversation about it. Usually it ends up being down to we're working on different time frames. We are looking for different type of return properties. It's just not that simple in the end. So there was 2 points. And I had 5, I promised you. So next one, and now we're getting to a little bit more meaty things. Position level thinking. This is one that always puzzles me a little bit as well. I mentioned earlier that I started out in this whole thing back in the mid-90s. Back then, I used to subscribe to what was then at least one of the biggest trading magazines. Those physical things, paper magazine, mind you, kids, that they would send to me from America over to Sweden once a month or something, however often it came out, with various ideas, trading methods, research people published. Once I actually joined the industry, I stopped subscribing to these things. Not too long ago, I picked up a copy of it. The magazine is still around, surprisingly. And I was really surprised it hasn't changed in this one aspect. It was exactly the same problem. It's completely full of research articles based on applying a single method to a single market. Position level thinking. It's all based on that the position is what matters. And I would strongly disagree. I think this misses the point. When you do these kind of things, you have very low predictive value because you're applying one method to one market. You have quite few observations available, a small statistical basis for analysis and conclusions. And that one market you've been trading may very well change. Market do change. It's very likely that your model is over-optimized. It's curve-fitted to that particular market. But even if that's not the case, it really misses the point, because to look at the positions too much is like the classic saying, I told you platitudes are useful or useless, but I won't let that prevent me from using them from time to time. You're missing the forest because you're staring at the trees. The point being, position level doesn't matter. All the thing that matters here is the overall portfolio level returns. You don't really care about how many positions you won on, right? You care about how much money did you win or lose in a certain time period on your entire portfolio. Now that implies diversification. And diversification is what people are really missing when they are looking at the position level. If you're trying to apply a single model, like figuring out what's the best way of using an RSI-based model to beat the NASDAQ, you have no diversification. You're completely depending on the market regime of a single market and a single methodology applied to that. There's a reason why people in the industry very rarely work that way. In the business, you usually look at multiple levels of diversification. You're looking at position level. Of course, there's one. That's the least important, but that's one of the levels. You also have a model level or strategy level, if you will. I'm using the words interchangeably here. So basically, one trading model applied on many markets. But then you have the third level, the portfolio level, where you can have many or multiple, at least, trading models, each of which are applied on multiple markets. And when you hit that level, the position level really disappears in the noise. It doesn't matter. All you care about is the overall return profile on the complex portfolio as a whole. Maybe some markets keep losing year after year, but you don't know which markets. You don't know which strategies. So you do many things at the same time, and you achieve better risk-adjusted results over time. Yeah, and that's pretty much what I just said, right? As well as that, I should forward the slides a bit more often, I see. Now the third point, and that is now it's increasing in importance with by the end of the list here as well. My third point has to do with risk. I would say most junior traders and pretty much all hobby traders or retail traders are missing the idea of risk, misunderstanding what it is. What I blame here is a large industry of authors, books, blogs, people who sell trading systems and so on, which all misuse the word risk, and newcomers in the field tend to use this strange definition. On the next slide, I have one sentence, and if you didn't pay attention so much so far to this presentation, and you don't plan to pay so much attention to the rest, perhaps, this is the one sentence you should remember. I would say of all my slides here today, this is the one sentence where you really should know this concept. Every part of this sentence has a meaning. I will explain it here and how this relates to the misunderstanding that I too often see. Financial risk is about potential value variation per unit of time. That's a simplistic view of risk, but it is still a correct but simple view of financial risk. Financial risk can be very complex, and I don't intend to go into that in any greater depth. You might think the reason is it would take too much time, or that I would lose interest from most of you in the audience if I do that, and both of those could be correct. But I assume I would say the more valid reason is that I am married to a financial risk expert, and I'd hate for my wife to explain to me in the evening what I got wrong. So I'll leave the gritty details to somebody else to explain. Now, financial risk about variation of value per unit of time. The part here that most people are missing is unit of time. To say that you're risking $1,000 on a trade, it doesn't make any sense whatsoever. Without a time unit, and without understanding it's about variation, not just loss, but variation, is missing the point. Sometimes when I attend trading conferences of some sort, I'm asked about how much I recommend that somebody risks per trade. And I always ask, well, what do they mean by that? The first time I was asked that, I was actually quite serious. I just didn't understand what does the question mean. What do you mean risk per trade? Per trade per what? But they were serious, and the question comes up very often. As I understand it over time, this was a concept I wasn't familiar with previously. I had to look into it after the first time I got the question. Apparently, it's quite common to see risk as how much money do I theoretically lose from my entry point to a theoretical stop loss somewhere in the unspecified future. That's not risk. That's not even close. That means that the risk level on a position would vary depending on the mental stop you have in your head. No, that's not how financial mathematics work, and that definition will not help you. You always need to look at how much it can move per unit of time. That means you have to take into account the volatility of the market. How much does it tend to move up and down, the market itself? And what does it do to the P&L, to the mark-to-market profit and loss of your position? That means you need to look into what volatility is and how to forecast it, and how to adjust your position sizes to the volatility. Then you're dealing with actual risk, and then you can start measuring how much risk you have on. You can look at how much, for instance, 95% confidence interval value variation on your portfolio per day. Now you're talking about risk, not how much you may or may not lose in the next few weeks if a stop loss hits. Now, much of the problem here is something that keeps coming up called money management. Money management is something that you will encounter in books and blogs and so on. Money management, to a large degree, is a collection of gambling methodology. Most of this comes from professional poker players or even blackjack players, roulette players, even slot machine players. This is not based on mathematics. Most of this is based on happy feelings, basically. Some of them are worse than others, but none of them take proper mathematical financial risk into account. A good example here is pyrimidine. Pyrimidine is based on the idea that you increase your position on success. You are, well, playing with the bank's money, to use the gambling terminology. Say, for instance, you buy a stock at 10. Now, when it hits 12, you double your position. It hits 14, you double it again. But then the question is, well, did the probabilities of success increase just because you had a lucky entry to begin with? Why would you have twice the amount of risk on your position just because you had a previous good entry? The market doesn't care when you had your entry. And what happens if you left the screen for a moment when the price was 12 and you come back when it's 14? Should you triple your position then? And if not, why not? They would end up in the same state. The important thing to remember here is what matters is your state of the position, not the history of it. When you bought is totally irrelevant. You just have to look at what is on at the moment, what kind of risk you have on right now, what kind of risk you want to have on right now. Your previous trading does not matter for that equation. So the solution to alleviate this problem has to do with understanding volatility and how it relates to risk. It can sound like a boring topic, and quite frankly, if you want to go into great level of detail, it is. But the good news is, as quant traders, you need to understand part of it. You don't need a deeper understanding of it. You need to understand how it works on an overview level. If you really have a math allergy, you can work with simplistic measurements like ATR instead of say, a smooth standard deviation and these kind of measurements. But do look into volatility. That brings us to the number one reason why people fail at trading: the unrealistic expectations on returns. And this is one of those head scratchers where it's always difficult to try to convince somebody who has unrealistic views that their views are unrealistic. but this for sure is the #1 reason why people fail. That people aim for return, which is not just double from realistic, but sometimes 10, 50, or 100 times what an actual professional good trader can make. The problem here is, if you aim for such returns, the only way to aim for such returns is to ramp up the risk dramatically. If you ramp up the risk dramatically, you will sooner or later have a drawdown that wipes you out. And this is #1 reason why people fail. Aiming for too high risk. Maybe you have a good month, maybe you have six months, that's great. Maybe you have a year, that's great. But aiming at too high return, sooner or later, it will hit you. The counter argument is always that people who say that are spoil sports. People who say that are the ones who tried and failed and couldn't achieve 1,000% a year. Well, yeah, sure. And the argument back to that is that the people who tell you that it's possible are the people making money from selling you ideas or systems or mentoring or whatever it is based on it. I recently had a conversation with a group of traders at a conference, which was a strange experience. I didn't really know how to approach it, how to react, what to tell them. But I decided to do a little informal survey. I realized earlier that something seemed to be a little bit strange. So I did an informal survey, and I just asked people over a drink session, how many percent per year do you expect to make? When you get good at this, what's your return expectation? And I found that general consensus, it varies slightly, but the general consensus among this quite large group of people was 20% per week. Now, if you can do this, and yeah, the math here is pretty easy to replicate. If you can do this, it means that you find $10,000. You start trading it, 20% return per week. At the end of the first year, you will have $131 million. Now, obviously, these are fantasy numbers. And you might, some of you probably don't even believe me that I had a whole group of people saying so. Others are probably laughing and wondering how somebody can be that dumb. But this is the problem. You get stuck in a subcult, usually on the internet, some sort of chat room, forum, some sort of subgroup that turns into a cult. And you get a reinforcement in the group, and people start believing it's possible. You hear the rumors about somebody who once did it. Somebody had a couple of good weeks, a good month. Obviously, nobody tells you about their losses. You often have a cult leader who cheers you on, who claims to have actually done this for decades before he turned to philanthropy and teaching other traders and so on. Clearly, this never happened in the history of the world, but there are people out there who actually believe this. Now, 20% per week is obviously outlandish, but numbers that are more often heard at trading conferences would be around, say, 20% a month, which would still turn $10,000 into $90,000 in a year. Now, this is still far out of the realm of possibility. Yeah, 1 year, sure, fine, but not in the long run. The problem is most strategies that look like they can do this excuse me, are so-called negative skew strategies or hidden negative skew strategies. They are a type of strategies, and there's nothing really wrong with this type of strategy if you understand what you're doing. Problem is if you don't understand what you're doing. A negative skew strategy is about type of strategy where you have a large percentage of winning trades. You win almost all the time. Small wins, but you win almost all the time. Now you keep cashing in on this. It looks easier and easier. You have a maybe 90% hit ratio, maybe more, and it looks great. You just ramp up the risk and you trade more and more. These type of strategies exist. The problem is they have a so-called negative hidden skew. They are prone to shock events on the wrong side of the spectrum. Sooner or later, you have a shock event that wipes out your entire account and often more. As I'm sure many of you have seen in the news, we had some disasters like this in the hedge fund world not too long ago. Option sellers losing a lot of money on these type of things. It's something that keeps happening, sometimes even to professionals, as we have all seen in the news in the past few weeks. Be very careful with strategies that look too good to be true. More realistic is in the region of, well, not realistic, possible anyway. 20% a year is, I would say, as the slide here says, world-class level. Any given year you can achieve much more, of course, but you will have losing years. You will have bad years and good years. But if you finish a 10 or 20% period with 20% compounded return per year, you're one of the best in the world. Now keep in mind that people like Warren Buffett or George Soros have returns over time lower than this number. And they made billions, right? So aiming for these unrealistically high returns is the #1 killer. Now, if that's the bad news is you're not likely to make, statistically, if you end up over 15% a year in the long run, you're pretty good. But the good news here is that the money in this business, the interesting money in this business, doesn't come from that. And there are interesting money in this business, absolutely. But again, take George and Warren, my old buddies. I never met them, but I like to pretend I have. Take these guys and look at how they made their money. Well, the money in this business is from achieving realistic, achievable returns, responsible returns at responsible risk for your clients. That way you can trade a lot more money than you actually own. You produce good results for others. Most people are very happy over time with a return of, say, region 15%. If you can achieve that, you get paid both by compounding your own money and you get paid on the fees from hopefully much more money from other people. And that's how you build something in this business. So keep in mind, of all these things, the #1 advice here is lower your return expectation and look at the risk side, understand the risk, and understand how the risk is impacted by your return targets. And I suppose all of what I said today, all of the slides can be summarized with these 2 words. Most of these things you can probably figure out for yourselves. But the problem is that most people don't start doing that because they read ideas and they believe that they are true because successful people told them so, which comes back to one of my earlier points. Now, no matter who says something, you look into it. Does it sound right? Does it sound reasonable? Can you verify it? Can you replicate it? And does it actually work? And even if it works, is it something that actually works for you and is doable for you in your situation? Now, I hope I have managed to convey at least some sort of wisdom between the lines here, and that I managed to, well, upset a few of you with some ideas. You need to upset people at times because that makes people think and question their ideas, and that's what I'm trying to do here. By that, I think I'm going to finish and check if there are any questions. I have a sheet with some questions that the good folks at Quantopian are typing up on a separate screen. We have a brave person in the crowd here. Somebody's asking me about about cryptos. What about this for crypto where average profits last year were 100 times plus? Well, no, I'm going to be nice here. When I first heard about crypto, I don't know, 6-7 years ago, I did 20 minutes due diligence on it. I looked up some background on some people behind this whole thing, behind the exchanges, so-called exchanges and so on. I replied that this is an obvious scam, and here are the math on how it works. Here are the companies behind it. This French guy in Japan, for instance, seemed to be cashing in and funneling money out. You can trace it very easily with public documents. This is clearly a scam. And besides, it's not useful for anything. Now, people spend a few years telling me I'm wrong, and the last year people are suddenly start telling me I'm right. My target is still 0. People are crazy. People buy up stupid things. It's not a trading strategy to buy a scam product and be lucky for a while. That's not a trading strategy. That's a whole different thing. Cryptos are not finance. So let's move on from that. What about the rise of AI and algorithmic trading? Two different things, I would say, AI and algo trading. Well, it's interesting. First, most people outside the business misunderstand what AI really means in the context of trading. It is significantly more simplistic than at least media tend to think what it is. It is cool stuff, don't get me wrong, it's cool stuff, but it's certainly not self-aware thinking, Skynet machines doing trading by themselves. It's very interesting. I see some interesting things coming out from it. Much of the interesting things I've seen has actually been these kind of high skew strategies, but well managed, as I said, that can make some good money. It's interesting. I'm not participating in that. I'm allocated to some of those things, but not trading it. I'm not an AI trader or a researcher in that area. Do I think algo trading and AI will destroy the markets? No, not really. They will create problems from time to time, but so they have for a long time. There's always been issues there, but the issue tends to be often that things are allowed which probably shouldn't, as in putting in hundreds of thousands of orders per second, moving orders once somebody is trying to get it, faking order depth. There are a lot of these things that sounds like they should be illegal, and they probably should be illegal, but they're not. And algo traders are doing it as long as it still is legal. Some of these things are a problem. The solution at the moment is don't compete with these guys. Don't step into their realm. Build your strategies in a way that they don't steal your money. If you trade too high frequency without being as good, as smart as them, having enough budget, you will lose. Somebody says, just like positions based on ATR, can we also use position based on equal weight for a portfolio? Yeah, sure, you can base it on whatever you like. But for stocks, it doesn't matter so much. My preference in general is variations of vola parity or vola targeting type of strategies. But for the equity markets, it doesn't have that much of an impact because equities have a reasonably similar volatility. Reasonable. There's a difference, of course, but when you're dealing with, say, cross-asset futures, you have an extreme difference in volatility. And to allocate equal notional, equal weighted portfolio there, it doesn't make any sense. Risk per trade doesn't make any sense. Could you clarify better alternatives? Yeah, sure. Look at the simplest way of doing a better, more complex type of allocation is measure what impact you want your position to have on your portfolio per day. How much value variation do you want your position to have on the portfolio level per day? Stock tends to move $2 up and down per day. You want to have you want the position to be able to impact on a normal day with, say, 500,000, or, well, sorry, if you're trading a smaller position, maybe 5,000 or 2,000 on the portfolio level per day. You just calculate how many stocks, how many shares does that mean? That's the simplest way of having some sort of sensible volatility, risk-based position sizing compared to this risk per trade, which doesn't mean anything really. Let me see, what else? What about trading a small capital? Is it a waste of time? Well, no, it depends on what you want to do. I mean, if you start with, I don't know how small you're talking about, but let's say you start trading 5,000, you're not going to make $1 million on that. That's a waste of time trying to make $1 million out of a few thousand. But if your goal is to achieve a reasonable return over time, if you want to hit your 15, maybe even 20%, usually, actually, to be fair, slightly higher returns are easier to achieve with smaller accounts. Not insane returns, but you can hit a little bit higher numbers with really small, tiny accounts. Not a waste of time. You might learn something. You might have fun doing it. You might make some money doing it. Then again, if you really don't want to care, well, buy a reasonable fund somewhere and be done with it. You do it out of, if you think it's interesting and useful. My list, yeah, that's a good point. Somebody says my list mostly applies to manual trading. Can they be avoided by removing human emotions in algorithmic trading? Yeah, in a way, but yes, you have a point. But remember this, a human built the algo. Now, if you have made these mistakes, if you have these preconceived notions that are talked about in this presentation, and if that impacts how you build your algo, then you have the same problem. And if somebody mentioned AI, well, machine learning. If you train a program, machine learning ideas, machine learning technologies, you need to give it some parameters. If you start training it with the wrong things, I mean, a scary example is the machine learning algos to identify potential criminals at the airport or potential terrorists, and it turns out that it basically just picks black people. Well, it's not the fault of the machine learning program. It was taught to do that. Machine doesn't figure this out by itself. You tell it what to learn and it learns it, right? And if you have somebody with a preconceived notion training the machine, well, the machine is going to end up with the same preconceived notions. Again, we're not talking Skynet here. My opinion on using volatility targeting on stock market indexes. It depends on what you want to achieve. It can be a good idea. It's not for everybody. It is more complex. It requires much more trading, much more time consumption. Clearly, what we know is that when we're talking about equities and equity indices, the type of market cap that most indices are doing, market cap weighting, is a bad idea for performance over time. And this is easily verified. If you compare the S&P 500, which is weighted off the market capitalization, where the largest few stocks are so enormous that they outweigh, the bottom 150 stocks in the S&P 500, doesn't matter. Cut them out, it looks the same. And compare the performance of the S&P 500 over time with the performance of the equal weighted calculation, or the equal weighted ETF tracker. And you see that equal weighted outperforms. So market cap weighting is a bad idea. Volatility targeting can be a good idea. I know it's controversial. I have, again, good friends who would argue with me, but I would say it's one of those points where intelligent people can disagree. Reasonable people can have different opinions. It's good for some context. Can you comment on going live with a backtest strategy? Should we allocate from the last result or start from scratch? That depends on your. I'm sorry, I got criticized a few times for saying it depends on every question, but I'm going to keep doing that anyway. It depends on the type of strategy. If you have a strategy that is heavily depending on diversification, take a simple example. At least a few of you on the list here probably read my first book on following the trend, on trend following futures. That's a heavily diversified strategy. It depends on the portfolio. If you only take new positions, it will take quite a while before you end up to be properly diversified, right? Because at the beginning you have one position, 2, 3, and now you have large swings which are totally different from your backtest because, well, you deviated. You just bought a couple of positions, not the whole thing. Such situation, you've got to take all of them. Then again, you might have another more opportunistic type of strategy. Let's say something that buys dips, for instance, some counter trends or mean reversion thing. There, it probably makes more sense to just take new signals. So, measurement of common sense. Does listening to the news or media help us or confuse us? That is the easiest question of the day. I have never seen anything useful from listening to the news. Obviously, I read the news, but market TV, no. I never had, as many people do, a large Bloomberg TV or CNBC, whatever there is, on the talking head and the trading floor all day. I don't know anybody a better way of wasting time than having somebody actually tell me the news in person. Clearly, you need to have a news ticker and stay alert of what's going on in the markets, especially these days. I mean, when we see the last couple of days when social media messages have made the market shoot up and down, and if you have short-term positions on and can be impacted by this, you need to understand what's going on. And I would say even if you don't actually trade on news, it's a good idea to stay aware of what's going on and follow developments. And I believe I'm being flagged for being out of time there. So I think, sorry, there's a few more questions, but I'm running out of time. So I will thank you very much for listening, and I'll head back to Paige at Quantopian. Thank you, guys.
Thank you, Andreas. That was wonderful. We will be wrapping up now. If you have a question that we did not answer today, you can email it to us at events@quantopian.com, and we will make sure Andreas gets a hold of it. So thank you everyone for joining, and thank you again to Andreas for a great presentation.